Aquí y Ahora, Here and Now, is a podcast created by and sponsored by PAG.law, experts on venture capital in Latin America. Many of the unicornios in Spanish, there are billion-plus-dollar businesses being built in Latin America, are financial technology companies. In short, FinTechs, financial technology companies. Today on the podcast, we get an insider's perspective on the radical changes taking place in the financial services industry and how this is disputing the industry's lowering costs and improving customer services. These changes are transforming our relationship with money and changing the very definition of wealth. Dwyer is Managing Director, Head of Strategic Business Development at Boston Private, a leading provider of fully integrated wealth management, trust, private and commercial banking services. Patrick is, for many, considered one of the most honest and insightful financial advisors in Miami and well beyond. Prior to joining Boston Private, Patrick Dwyer served as private wealth advisor at Merrill Lynch for nearly 3 decades. During his time at Merrill, Mr. Dwyer earned numerous accolades, including Forbes #1 Florida Best in State Wealth Advisors, Barron's Top 100 Financial Advisors in America, and the Financial Times Top 400 Financial Advisors. Ladies and gentlemen, with pleasure, we leave with you Juan Pablo Cappello, founder of PAG.law, and Patrick Dwyer.
Patrick, thanks for joining us.
Thanks for having me. Good morning.
Yeah, this is great. It's a little more morning here in Aspen than in sunny Miami. So how are things in Miami? I have to say I didn't understand the Cuban expression candela, which means like really hot, until a few weeks ago when with COVID spiking and with the temperature spiking, it seemed a little candela.
It's a little candela in Miami. It's hot, it's raining, and everyone is calling asking if what is going on in Miami because of the outbreak down here. But it's actually pretty chill. It's not it's surprisingly it's pretty quiet. We haven't, it hasn't, it's a lot quieter than the press says it is. Let's put it that way. In Miami, it's a lot more.
Oh, yeah. I mean,
I look forward to coming to Colorado in a few weeks and seeing you, though. I've had enough. I need to go into the woods just like you do to Telluride, where I go in the summertime, to try to de-stress from COVID. So.
Yeah, it's super interesting to me because one of the things as I have thought about for the last 10 years, helping support and nurture a tech ecosystem in Miami, and I know you've been passionate about that as well, is, in Miami, leaving aside the illicit industries, the two main industries that, above board industries that we see are sort of real estate and asset management, right? Those have really been, I think for the last, probably 100 years, big drivers in Miami. And, you're obviously in the asset management business, one of the real, go-to people in Miami, in part because, you're one of the pioneers in terms of really, professionalizing the space. And so, I wanted to talk a little bit about that. How do you see the financial services and asset management industry sort of changing and evolving? And then, how does that sort of play into the growth of a tech scene in Miami?
Well, that's a really interesting question. I do think the tech scene, to answer your first question, is going to get bigger in Miami as time goes on. And I think principally because, one of the main reasons you've had tech clusters, it goes back to the business school models from Michael Porter is, you have all this industry expertise in San Francisco,
Right.
and if you're in the industry, you want to be there because that's where the jobs are, and if you lose your job, there's more jobs there. But what COVID is done is just accelerate. The place is going to be a little bit less important. I still think place matters, but it's going to be a little bit less important. And you're having, the default is that all of these entrepreneurs in tech in the Northeast, in California, and other places, a lot of them have come to Miami during this period of time. They've been coming anyway for tax reasons. And I think
Right.
now what you're going to have is you're going to have more of these entrepreneurs move to Florida because of COVID and some of the issues around COVID, which is you're going to have massive tax increases around the country. It's state and local level.
And why
tax
do you,
increases
sorry,
in Florida.
let's talk about that. Why, when you say just because, COVID, et cetera, states are just going to find themselves in a position that they have no choice but to try to raise revenues?
So the amount, the size of the deficits that we're facing are just epic, and they're coming at the same time that entitlements are exploding in the U.S. Right. So entitlements meaning baby boomers are hitting retirement age, right? And and we were already going to have challenges paying that out. So now we have the entitlements all hitting at the same time as COVID-19 is putting an epic pressure on state and local budgets, and of course federal budgets. And so what essentially happens to a country like the United States that already has a lot of debt. I mean, I don't want to get into all the numbers,
Right.
because I think it's less relevant, but just we are at debt levels that are dangerous in the United States, and we're going to have to monetize debt like a third world country. And the Federal Reserve basically has taken the position that they don't want us to become Japan, meaning that what their primary concern is that a mindset of deflation sets in. You start thinking prices are going to go down in the future, so you delay purchases. And that's the scariest thing that the Fed sees out there. So what they want to do is make sure we have inflation. And so they're throwing money at this thing. And then the federal government is doing something that they've not done before, which is, well, they did it a little bit under Obama, but not much. Fiscal spending. And so the fiscal spending is going to be epic, meaning the government writing checks and spending money. We've always had the Federal Reserve doing it. Now we have
Right.
the government doing it. And what, they're going to have to do it because they're filling this giant hole left in all of these city, state, and local governments. Just imagine, I haven't seen the numbers yet in Florida. Imagine what the sales tax numbers are down. I mean, it's got to be enormous. There's no tourism. There's all these businesses that are just that these states are dependent on are really hurting. Remember, we're a service economy in the United States. That's 70% of the business. Travel, entertainment, all those things are huge. So this is going to have a multi-year ding to state and local governments revenues. So they're going to be raising. If you own a piece of property, your taxes are going up. Sales taxes are going to go up. They have to do this. There's no way around it. States can't borrow unlimited, and the states that haven't dealt with things like California, like New York, states that are already deeply in debt, are just going to be that much worse off afterwards. Even if the federal government comes in and kind of throws a lot of money at the states, it just doesn't matter. If you live in one of those places, if you're a tech entrepreneur in San Francisco and you can move, you're thinking about it right now because 52% tax rate was high. It's going higher. So at some point there's a diminishing. You're like, you know what? I have to deal with this, and I think so. So you'll have a little bit of that. That's going to again, it's just accelerating an existing trend, right? That trend was already in place. We already had demographic issues in the United States where we have more, we have less and less workers in the workforce, because the older workers are retiring. And so that's one big trend. I think it's going to affect where we live in Miami very positively, but just think about Texas is another state where you're going to see a huge amount of tech people go to. But I think what you'll have in Miami is, and in Florida is, I do believe you'll begin to have a little bit more of an infrastructure of high IQ people with strong skill sets. Some of them will be coming down here in financial services, which is easily transferable. So you'll have quant people coming down, you'll have tech people coming down. And guess what they'll do when they come here? It'll be no surprise, 5 years from now, 6 years from now, there'll be new businesses being started in Miami. You're going to be a busy guy because you're going to see the tech industry, your industry, really, really grow here. And in particularly with regard to Latin America, Latin America is also here. And we have a lot of languages in Miami. You have people from all over the world who live here, and I do think this will continue to grow as more of a hub for services, financial, tech, and otherwise. And I think this is just going to be the next evolution of that. And we're going to have a lot of empty office space. It's going to be very cheap too when this is done. So I mean, when you consider the fact that businesses are going to be reducing their office space, Miami is going to have Class A, beautiful office space for $40 a foot in really nice buildings, and that's also going to be a competitive advantage for this city. It's going to be a real competitive advantage. So I think that's going to be very good for the city. You asked an earlier question about industries, and I think I think my industry, the financial services industry, is going through a dramatic change, and it's now happening sort of at light speed. And that's really, what this entire environment that we've been in has driven down interest rates to incredibly low levels. And what that really means,
I just saw the 30-year mortgage is under 3% for the first time ever.
At a very basic level, this is a massive problem for savers and retirees, right? Because they can't get a safe yield, right? So if you're a pension plan, if you are, if you have let's just pretend you have $100 million, right? What kind of a safe yield can you get in the bond market today, tax free? 0.75%. So that's not a lot to get.
It's not a lot. Right. If you have $100 million to live off $750,000, doesn't feel like you're living that large.
Right. So that's financial repression, right? And that's what the government is doing, and they're doing it because they're essentially trying to force you to change your behavior and take more risk, right? They want you to take your capital, invest it in a business, take risk, buy stocks, do something like that, because that's what they want you to do with your cash. And what that means, so I just mentioned taxes are going up, right? They're going to go up. I mean, all the Trump tax cuts are going to be gone. Doesn't matter whether he wins or somebody else wins, they're going to be gone, because you can't keep borrowing money like this. The rest of the world has actually slowed their purchases of United States treasuries, which is why the dollar is getting a little bit weaker. And they're not going to sit back and lend us another $10 trillion for 0%. Unless we have to have a plan to pay it back. Like, they're going to say, gee, guys, like, it'd be nice to know that, like, your general public, who is now, is really decided that there's all kinds of free things that they want. Other people have to provide us with that money, right? So we have to go out with our hat in hand and say, please, would you lend us the money? And as the rates go down, obviously people are going to be less excited about lending us that money, right? And so this is going to be a real problem. So they're going to have to raise taxes to address it, also to say to the credit markets, we're serious about these deficits. What they really want to do is they want to get inflation going, right? They want to get inflation going so we can inflate our way out of this debt, right? So if you have fixed rate debt, which we do, right? If you have fixed rate debt, the best thing you could do is say, if the inflation rate is 1.5%, if we could get it to 3%, we will have an easier time paying that debt back. And
because you're paying it with deflated dollars, essentially.
Right. That's exactly right. And so that's really, at a very basic level, that is what has begun, and it's going to change the nature of wealth. Having said that, the industry is also changing to reflect this. And the financial services industry was already a business where pricing was going to zero. I mean, that's basically Fidelity, where we do everything.
Right.
Everything is zero. I mean, they even have zero index funds. They don't pay anything on the index funds. And so the industry has already come to zero. Now it's potentially, they're going to be paying you to do things eventually. But they've basically, Fidelity and Schwab have been like open source software, and financial advisors can use them as their platform, individual investors, family offices. And that trend really began in California, where all trends begin in the United States. I mean, it really did. The Schwab and Fidelity have gone from small players 10 years ago to dwarfing the amount of assets that the big firms have. So the JP Morgans and the Merrill Lynches and the Morgan Stanleys, if you add up all the money that they have, it's substantially less than what Fidelity and Schwab have. They are growing at a rapid clip because they have open source software that anyone can plug into. It's an open system. And so, like everything, financial services is people are gravitating towards open, conflict-free systems where they can where the consumer has the most choice, the most discretion, and gets treated the best. And in California, where everybody's an engineer, right? They're all engineers in Silicon Valley, and they have a lot of money, and they know how to do math. So they have kind of rejected the traditional model and and really move towards all these new models. And what's happening now is necessity, is forcing investors in the rest of the country who have never contemplated this to say, you know what am I paying? What is this costing me? How much are you paying me on my money market? What are my account fees? What are my manager fees? What are my
Well, so sorry to interrupt, but I mean, it would also seem, just tying back to what you just said, that if yields are way down, at least on on fixed rate instruments, suddenly the fees you're paying become much more relevant. If your money market account is paying you zero, as opposed to if it was paying you 3%, right?
Oh, well, yeah. Another way to think about it is, imagine that, and I'm just making these numbers up for example purposes, but just think about this. So right now, everyone's like, oh, everything's going to be okay. The stock market's up. Well, stock market's up right now, but if you just think about cash flow, right? I mean, at the end of the day, cash flow is really key for people when you retire. And so most people live on some combination of dividends and income from bonds, right? So imagine that today, let's just say your income is $1 million from that. You're a very wealthy person and you have $1 million worth of income, which would probably be about a $45 million portfolio, right? That's what that would kick off today. Well, if you're retired, right, you're probably paying about 25% on that if you live in Florida. If you live in New York, you're probably paying 32% on that, okay?
Right.
Cash, and that $1 million, right? So you're taking home $750. Well, if all the tax increases go through that they're talking about right now in the Biden campaign, and assuming that Trump's get expired, and Trump would have to raise taxes too, there's just no question. So I'm not making a political statement. I'm just saying, like, this is what's coming.
Either way, it's going to.
You're going to pay more taxes.
All roads lead to Rome.
There's no way you can't pay more taxes, right? So now you're thinking to yourself, okay, well, if they start charging you at your marginal rate on your dividend income, on your capital gains, in other words, you're going to pay ordinary income rate on everything. That's what they're going to do. And the AMT comes back. That individual who was getting an income off his portfolio of $45 or $50 million of about $1 million is now going to take home less than $500,000. So they're going to have a quarter of their income thrown out. At the same time, the dividends are going down, that bond yields are going down. So their sources of income are going to pay them less. I mean, dividend rates are not going to be going up for years. We're going to have a couple years of slow to no dividend growth. They're not going to be stock buybacks. Companies are going to be paying more taxes as well. So corporations are going to pay more taxes. When they have to pay 20% more in taxes, guess what? They're going to pay out less, right? So all of these things, these are massive headwinds for investors. So and then what else is happening is that you're living longer, right? Although COVID can certainly change that. COVID can solve that problem. So people are living longer. So you're retiring and you thought you were all set, because you had whatever you had, and you thought, well, if I spend 3% or 4%, I'm going to be fine. And then you start looking at this and you go, oh my gosh, I'm not going to be fine. And last but not least, we're really predicting that, frankly, equities are going to have lower returns the next decade. And every single firm on Wall Street has the same 10-year projection range. It's about the 10-year projection for the S&P 500, which the last 10 years was 13%. Is for a return somewhere between 4 and 6.5% is what Wall Street is saying. And that's looking at every firm. Nobody's saying 9%. Nobody's saying 10%. So if you get 10 years of a 5% return with inflation at 2 or 3, you're spending 3, your taxes went up, you have no yield. What that's really doing is it's forcing investors to sit down. They're going to have to take this opportunity in COVID to rethink what they have, to think about what return they need. How much are they going to spend? How do they address these issues? And it's a lot. And I think people who don't address this stuff are going to have 2 or 3 years are going to go by. Their portfolios are going to be behind. And I think you're going to see a lot of rich people not be rich in 10 years. That's what happens when you go through periods like this. It changes the nature of wealth.
It's very interesting it really. And then I want to talk about the sea changes in your industry, but it really, as you're talking, what it sort of crystallizes for me is that investors are going to have to take more risk, right? I mean, I think what you were saying was, for at least, the last 10 years and probably the last 40 years, as people got older, and had accumulated significant assets, they were in, a position where they could take increasingly less risk and, have an income stream that supported their lifestyle. And I think,
That's right.
from what you're saying is that,
Not going to happen anymore.
It isn't going to happen. And so people are going to be forced to take more risk in order,
or shrink their estate. Their estate. And the issue for most people isn't that they can't shrink their estate. They can die with less money, right? That's fine. But the issue is most people, like you and me, have children, and our kids are, the generation that has money is the baby boomers, right? You and I aren't baby boomers, but we're Generation X. Our generation actually does not have very much money at all, but the baby boomers have tremendous wealth, and our generation we're on the older end, has some wealth. But our challenge is going to be, our kids all have expectations of life, and those wealthier families are going to be sitting back going, well, the estate tax is going to go up. So let's just say your estate doesn't grow, which is really what I'm telling clients.
Right.
Look, if you don't take a lot of risk and you don't cut your spending back, which you don't have to do, you can just accept the fact that it's going to shrink.
But as you said, the big problem is very few of us, birth certificate has a fixed expiration date. So we don't know what our target is. Most of us are terrified of being, 93 years old or, 95 and being a burden on our children, especially if we'd accumulated a significant amount of wealth earlier in life. And so, you're really...
And it takes I think this next 10 years, you're going to watch a lot of people become formerly wealthy. And I think, but the bigger challenge is when addressing all this is, the estate tax is going to go way up. So that's going to shrink estates at death. And that means that, if your kids had an expectation that they were going to get some money down the road, and by the way, I think this next generation is going to need it because they're going to be making less money and absorbing these higher taxes, right? So they're going to be paying these higher taxes. So their ability to accumulate wealth is going to be very constrained. So people really have to think about, okay, if you happen to be the successful person in your family, right? Like, let's call it like you're like the family bank, right? People counted on you in the family for emergencies. Like you have a cousin and they needed $10,000 for an emergency and this and that. And you're the person helping other people.
Do you have the same cousin?
Yeah, I
do.
have a lot of cousins. I'm Irish Catholic, and we have I have a lot of relatives, and my relatives are fabulous. By the way, they are absolutely fabulous. But but I mean, it's really, so these things are going to come home to roost.
Yeah.
And one of the great things about the period we're in, though, is technology is actually giving us tools to help us do this. And so what we're really trying to do is copy what's been done on the West Coast very successfully, and in New York and in Boston, which is where RIAs, which is and multifamily offices, have really addressed this by being more cost effective than the big firms, because it's a simpler business model and they use tech. I don't have to pay to use Fidelity's platform. It is a more modern, is it a better platform than Morgan Stanley or Merrill Lynch? It really is. I've worked on the Merrill Lynch platform. It's much better. It's got much better technology. It's got a much better breadth. That's everything there. And it's free. Like I don't have, it doesn't cost me anything to use that platform. So the RIAs have this strange cost advantage that's built out of the fact that they can stack tech up, FinTech on top very inexpensively, very efficiently, whereas the big legacy firms have basically got a whole different model that's not working, and they're losing market share pretty rapidly because customers are voting with their feet. They're moving to these new platforms pretty rapidly. Less so in our market because people haven't really been educated about this, but they're getting there. It's funny, there's certain markets in the country that are very brand oriented, and I would say South Florida is one of those. And the reason it's brand oriented is people here, like, look, you and me aren't from here. Like nobody's from Miami. They didn't grow up here, so they don't know people in the same way that if you grew up in a place you would. Like you go to Northern California, most people I know there grew up there. They know everybody there, and they're much more comfortable with RIAs, and they actually hate big firms in Silicon Valley. That's their whole mission, is to destroy them. The tech guys think that the big banks are a joke, and they don't want their money there. They specifically don't. And I think that trend is going to roll this way. We're seeing it happening. I think initially it'll be over cost, but the second thing is that what people really want is, clients don't want to be trapped. They don't want to be trapped in the system. And so, when you're at a place like a Fidelity or a Schwab, whether you're getting advice from somebody like me,
Right.
you can fire us and go manage it direct. You can hire somebody else, and you never have to move your money. Right. And so your money stays there. And so that becomes like this other thing that like is just very compelling for folks. But people are going to have to address these issues. So I kind of go down a list of what I think people need to address. And by the way, I'm doing this personally. I started doing this about 4 years ago. I was looking at the environment and I said to myself, you know what? I'm worried about clients getting their goals. I'm worried about me running out of money someday because of this longevity issue,
Right.
And all these demographic things that are piling up, which are going to be headwinds. And I think what you really have to do is, from an investment perspective, you have to, first thing you have to do is control the things that you can. Right? I can't control the market. I can't control any of those things, but I can control my fees. I can control my risk through my asset allocation. I can definitely control my taxes because I can control the types of investments that I own and make sure that they're tax efficient. So those are all things I can do, and that's the first thing we want to do with clients is make sure they have a super tax efficient portfolio at the lowest cost that we can give them, and then we've dealt with that issue as directly as we can. The next thing you got to deal with is all the other assets that families have. And
exactly.
Right. And so what happens is is if you're for wealthier folks is that you start accumulating things. You start accumulating houses and stuff, and you know what I'm talking about.
Yeah. and been there.
Yeah, I've been there, done that. And so people start accumulating things and without really considering the carry costs. And if you're if let's just say you have X amount of real estate, you have 2 homes, 3 homes, whatever they cost is irrelevant. But they all cost. A home is not an investment, and it is viewed as an investment by many people. You can absolutely make money on a house. I've made money on homes before, but most of the time when you make money on a home, it's you bought in a recession, interest rates are falling, it drives it up, or you built a property and that's how you added value. Right? But in general, home prices don't appreciate that much over time. They really appreciate about 4%. Inflation's 2%. You got to carry the cost of it. And so when you really back it all out, you don't make that much money, if anything at all. But now, I think homes are going to be even viewed more as a cost, because if your house cost $100,000 to operate and your income is crimped by all the things we just talked about, you'd like to get your operating cost of the house down to 50 grand or whatever. You'd like to get it lower. And so I think what you're going to see is the trend is going to be wealthier folks, particularly our age group, by the way, people who have longevity. Like we have to think about, hey, I might live 30 more years, whether I want to or not. Well, people are still going to have nice homes. I think they're going to be smaller. I think people are going to be a little bit more millennial-like. And so what I've done is we downsized our big house when the kids left, which was just sort of like saying, hey, you know what? I don't need a 10,000 square foot house for 2 people, right? That seems a little excessive. So we moved to a smaller place, a substantially smaller place, and expensive, but better location, much lower maintenance costs. And then anything you're not using, people are going to start getting rid of. If you're not using something, you're going to start getting rid of it. Because if you've trapped assets, if you've got 30% of your assets not really generating a return for you, and returns are getting smaller, you kind of need to put them back into the producing pile for you. In other words, and I also think what this really means is people are going to use leverage on their homes more than ever, because by using the leverage, you're not trapping the capital inside that house. And so I think that's going to be really important. And people are going to want to have more and more of their assets as working for them, whether it's commercial real estate or whatever that is. You need to be earning some kind of return. So I think that's going to be really key for people to keep their, if the goal is to grow the wealth and for the benefit of yourself or for your kids. If your goal is not to grow the wealth, that's different. And if you're 70 years old and you say, hey, I don't care, that's fine. But most people want to grow it for their kids. That's the biggest, that's their biggest concern, is like, hey, geez, I don't want to leave these guys with nothing, because I don't know what their future looks like, right? I mean, we don't know what's going to happen 30 years from now. So
I want to talk about, it's interesting. One of my favorite expressions is, there's decades where nothing happens, and there's weeks where decades happen. And in the tech,
that's a good expression.
In the tech world, what's super interesting, from 2010 to 2020, we saw e-commerce penetration grow from 5% to 15%. So 15% of sales at the start of this year were online. In the first 8 weeks of the quarantine, we went from 15% e-commerce to 28%. And so, you know, it wasn't only that, you know, people got comfortable on platforms like Zoom or whatever, people obviously began buying a huge amount more online, et cetera. And so you've just seen this, you know, thanks to COVID and everything that's going on related to this pandemic, you know, just these trends that were happening just get accelerated in a way that would have taken, you know, 5 or 10 years. And I mean, for what you're describing in this macroeconomic environment, in terms of, you know, yields, you know, in terms of, you know, yields being pushed down, taxes by definition having to go up, given this deficit spending. You know, what do you view as sort of the macro trends that have been accelerated, you know, from your perspective, things that might have taken 5 or 10 years to sort of happen that now are going to likely happen in, you know, 6 months or a year?
I think, well, certainly you know, we are in the fourth industrial revolution. That is, and
right.
It's going to accelerate now, and there's going to be winners and losers. And there's going to be, you know, I think one of the things that investors have to be careful about here is overhyped stuff. You know, there will be enormous losses. There will be a lot of,
right.
You know, tech is a risk-taking industry, and people need to understand they're taking a lot of risk for hope. But I mean, tech clearly is a massive secular trend. So I would say, you know, obviously the green energy secular trend is moved from, you know, is moved into the category of a lot of the areas are very close to being economically viable in a scaled way around the world. So I think you're going to see huge boom in green infrastructure. And
right.
By there, I'm principally, I think electric cars are here. I think that's coming. If you're watching what's going on with Tesla and all the excitement about Tesla, at the core of that is people understanding that you're going to be able to very shortly, it will be much cheaper to make an electric car and service an electric car than a regular car.
Right.
You know, forgetting about the environmental benefits, it's just going to be less expensive, and there's less parts in it. So that's going to, and if you think about their business model, and this is same things happening in all these industries. So Tesla's a really good example of like what is going to happen. So in the pandemic, this pandemic was the biggest possible upside thing that could have ever happened to that company, because all of their traditional competitors were having to invest in electric cars, right? And this is enormously expensive, and they're way behind Tesla. They're 8 years behind Tesla in every respect, right?
Right.
But they still have their legacy businesses. They still have to invest in new pickup trucks and new luxury cars and all these other things that are kind of dying markets. But they have to pour money into those things, and at the same time, they have these legacy costs, which are dealerships. Tesla doesn't have dealerships. They have, you know, you order a Tesla online. I've done it.
Right.
You buy it. We bought our Tesla online.
Yeah, we both have been
yeah,
there.
you get
amazing.
it, you plug it in, and you're done. Yeah, my Porsche requires tons of maintenance, and I'm going to get a Tesla next again. But so they don't have dealerships. So all of these things, you know, they don't have these legacy costs. They don't have unions. They don't have legacy pension plans from the last 50 years to deal with. So they're coming into this with actually becoming profitable for 4 quarters. Their business is accelerating, and the whole world is about to invest a whole lot of money in infrastructure, basically to keep people employed after COVID. And it's going to be green infrastructure. What are they going to be investing in? They're going to be
and actually, Patrick, hold on. Let me and I mean, I think that's an amazing segue. So compare that, because I think there's a huge amount of parallels with your industry in the sense in financial services. Why does somebody like you all at Boston Private, who are using this platform, you know, how are you guys sort of, you know, trying to replicate? Because, you know, what I find super interesting is, you know, you see these trends, and a lot of times, you know, people like me, it's like I know one industry really well. And so I see something like you're describing going on in green tech and with Tesla. I see that happening. And what I don't realize is the same exact trends are happening in financial services, in real estate with Compass. You know, that it's almost like all these industries are being disrupted in the same way. So you just gave a really nice explanation of what's going on with Tesla and green energy, and why the car makers are having a difficult time to compete ultimately, and they're being disrupted even though they don't even realize how much they're being disrupted today. What's going on in financial services?
It's pretty much the same thing. Like, you know, in the car business, like the parts is where you make all your money in service, right?
Right.
Tesla has completely ruined that for them because there's only 20% of the parts. There's like no maintenance and no service when you go to the Tesla, right? So that's ruined that business. The financial services business, the full service side has always been, you know, they've always come up with the new shiny object to make money off people, right?
Right.
Hedge fund business. I mean, you know, you want to pay for some guy's jet, invest in a hedge fund. I mean, and so these most of these strategies have not worked at all. Like indexing
Right.
has really worked much better than hedge funds. Private equity has done much better than that because they actually, but even private equity's fees and everything else are under pressure. But what's really happening is sort of the retail level in financial services is you can automate your banking and checking really easily. So you don't need to pay for a really expensive assistant to do all this stuff for you. And if you want to do that, you're going to pay a lot more for service. And, you know, so you're going to pay, let's just say you're a reasonably wealthy person and you want a super full service support staff for your banking and checking and everything. You're really, you know, service client. You're going to pay $50,000 to $75,000 a year more for that. If you're making $800,000 a year, is that really how you want to allocate? You know, you're going to give 2 months of your, I always do it as like months of your spending. Like how many months you're spending when I can automate this. So what's happening is like people are figuring out how to automate all these different things, and that makes them less dependent on these full service environments. And then providers are saying, look, if you will engage us with tech, if you will let us use tech to solve all these problems for you and make your life better, that's what we're really trying to do with tech. It's going to cost you less. You just have to engage enough to learn how to do this and then move on. And that's really what's happening in the business. And the bigger firms, like the traditional firms, sort of are you know, they capture that client and then they want to milk them for as much as they can profit-wise.
Right.
And then the rest of the industry, FinTech and the RIA industry, is basically trying to take those profits away from them. And that's what they're doing. They're pricing underneath these guys and saying, hey, you don't have to pay for all that stuff. We can find ways to do things differently. And that's what's happening. And there's just a level of competition is just unbelievable. So like I do a lot of direct indexing, which is essentially you build your own custom index for a client and you can do anything with it. And I remember going through this, we're doing it for a client for about a $15 million position.
Right.
The client was like, okay, so how much does this cost? Like thinking it's going to be, I'm like 20 basis points. That's you know, I mean, and if you're like, it's 20 basis points. I mean, they have basically that same product 10 years ago would have been 100 basis points. And
Wow.
it would have been really complicated. It would have taken me like to do all the different things. Now I just go click, 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 click. I work with the quant teams. The next day they get it back to me. It's just you can basically deliver to a client today with 30 or 40 or $50 million institutional pricing, just like a $500 million family would get, with no conflicts of interest. And that's what people are doing. They're basically saying, you know what, I'm going from, I think I saw an article about UBS, that their average $100 million client was paying like 700 grand. That's just over. Those people aren't going to do that. That guy's probably paying 30 grand for his tax. They can pay 100,000 and get the same exact thing. And that is basically what people are figuring out. And it's going to happen. It's just starting in this part of the world. I think it's really going to accelerate as people begin to have to deal with the reality of this situation.
That's so interesting. I mean, again, this is so eye-opening for me because, right, I mean, as I said, like, you know, with e-commerce penetration, I mean, it really seems in financial services, get the hit on yields, taxes going up. I mean, it just puts such a huge amount of pressure on fees. And if, as you pointed out, I mean, you haven't even talked too much about the inherent conflicts of interest that are often in the, you know, in the more traditional firm models.
Well, the conflict of interest are really, they're not, I wouldn't say having been advised.
I want to call it.
No, they are conflicts. They are conflicts.
Disalignment of interests, right?
I give you the perfect example is like, you know, at the bigger firms, if you want to put your client in a money market fund that pays more, you have to like physically buy the money market and sell the money market like a stock. So they make it very labor intensive and a pain in the butt. So that the default is to put the client in the zero interest rate account. And, because they make a fortune on you, right? I mean, let's think about it. Like, so like, it's like, I look at this and you look at the math and you say, okay, if the client has an average balance of $1 million, right? Just do the math. And basically, like, at Fidelity, they're getting 100 basis points more over a 10-year period on average on cash than they are at a big bank.
Right.
That's $10,000 a year times 10 years. That's $100,000. Like, that's a lot of dinners out. You could, like, and for nothing. I mean, what is it? I mean, does anyone care what, the name of their money market fund is? I mean, who cares? Like, it's a money market's a money market's a money market. It's just one charges more and one charges less, and it does exactly the same thing. So you're talking about, it's not like fashion brand where you could say, Chanel has a nicer fabric. I mean, ETF, S&P ETF is the same at Fidelity, Schwab, Vanguard, JP Morgan. It's the same damn thing. There's no difference. There's zero. And yet people are paying more for it. And so that's like what's happening is there has been no rationality to our industry. Right. It's all been about the shiny object. And the big firms capture the client. And then as their margins are collapsing, what they're doing is they have to kind of come up with new ways to make money. So they lower clients' fees under pressure, and then they sell the client a structured note that costs 2.5%, or they have a new private equity product that has enormous embedded fees in it for the firm, and then they're find another way to leverage the guy up to generate some more capital. But that's what the big firms have to do because their margins are collapsing and their business is shrinking. Every single year, every single quarter. So Morgan Stanley brags that they have a 27% margin, right? I want you to think about that. 27% margin. In today's world, that's insane. Okay. If you're paying a 27% margin, you got to be asking yourself, like, why are you paying it? If no one has beat the S&P 500 in the last 10 years, like nobody's beat it because it was impossible to beat. What the hell are you paying that kind of a margin for? To underperform? I mean, it's not. Right. People aren't logical. I mean, they're not logical, and they only get really logical when their personal financial situation comes into jeopardy. And unfortunately for a lot of people, they're going to figure this out in 3 or 4 or 5 years when all of a sudden they haven't gone anywhere. And they're going, wow, and then they're going to figure it out. But I think the smarter families today are addressing these issues and trying to use technology to take advantage of the situation. That's what businesses are doing, and that's what ultra high net worth individuals are doing. Pension plans are doing this. They're really all kind of slowly gravitating to this model. So I think the world is changing. I think it's going to change a lot more. Compensation in our industry is also going to come down a lot. Right. And it has been coming down for 10 years, but I mean, the industry is people are going to earn significantly less. There will be people who make $1 million a year in the business. There are not going to be lots of people making $5 million, $10 million, $20 million a year. That's just not going to happen because that's the margin. That's the customers paying for that. That's right. I mean, he can't afford it, and they can't afford it. 5% muni bonds, the customer could pay for that and not care. Now they're going to care. So that's the environment we're in. It's going to be tricky. And what people are going to move towards is the model that they pay their CPA and attorney for. Your clients, when they pay you, they physically write you a check, and they know there's only one way for you to make money. You're billing for your legal services, right? I mean, that's it.
I need to show I added value every month, or they're not calling the next month, right?
Right, but you don't have another way to make money. Like if you're dealing with a CPA, you pay for the service that you use. If you use more service, you pay for more. But it's very clear cut. Your CPA doesn't come to you with ideas that he'll generate more money off of. He doesn't. That's not how it works. And so with the RIA business, you negotiate either a fixed fee, which is increasingly the way people move, or a variable fee, but that's the only compensation an RIA receives. They don't receive compensation from the underlying investments or anything else. It is a really straightforward proposition where there's not ways for the advisor to harm you as a client. They can make the wrong investment for you, but they're not going to make extra money doing that. Let's put it that way. Right. They're not making a fortune, and that's really where where it's different. And once you get over to this side of the business, it's also much better because you're always doing the right thing for the client. You don't have to. You're not dealing with the firm doing the wrong thing, and you having to kind of get in the middle. You're not having to question, hey, why are you guys doing that? Like, and so that's really the big difference. And I do think that that's the way the industry is going to go. And there'll be more people that do things direct, but there are opportunities in the world. So I think non-US equities are going to have 8 or 9% returns, maybe even higher. So they may have really good returns the next decade if the dollar can go down. So there'll be opportunities for clients to do better than 5%. But that's that should have, in a normal decade, they'd be doing 13%. They're going to be lower. So I think, again, the challenges are going to be with us for a long time. And then I think the other thing that investors in the U.S. have to think about for the first time ever in their life, and you and I have to think about, is political risk. The U.S., and you're from Chile, so you understand political risk in a different way than an American would. I was a history major as an undergrad, and I think political risk, the risk that this union comes apart in some way, is a small risk, but it is a risk nevertheless. And then anytime you go through a period that reminds you of the 1960s, something bad can happen. Doesn't have to, probably won't, but it could. And so I think investors are also going to have to think about investing money in some of our rivals, like China, who I think is China is our frenemy, right? They're public frenemy number one.
Absolutely.
We need them for some things. We're codependent, but they are clearly, they want to be number one, and they have great tech. And so we've begun investing in tech in China. Really the only direct investments we're making are tech in China, because China has the other great tech companies of the world, and they have a closed market. I mean, they have their ecosystem is like a pond. You write software in China and you can't get out of the pond, right? It's trapped. So their companies have this massive home market, just like the US, that they can scale. And the Chinese are way ahead of us in tech and tech infrastructure. They've already built this incredible tech infrastructure that we haven't done yet. They've done a lot of deficit spending in China, but they haven't spent the money on transfer payments. They've spent it on building infrastructure, which they get to use for the next 100 years. We have really done dumb things with our money. We've done it for transfer payments, and we have not built infrastructure. We can't look at our deficit and go, yeah, but we got all this great roads, bridges. We don't have anything. And
no,
so
we kept some people employed for 56 days.
Right.
With the PPP. I mean, that's
right. And so what I think will happen in the United States is we're going to move towards permanent infrastructure stimulus. Instead of spending $3 trillion every time we have a recession on transfer payments, you just build roads and bridges forever. You borrow the money, but it keeps people employed. And I think that's what we're going to do. And I think back to the Tesla and other, it's going to really do is it's going to drive the build out of the U.S. digital infrastructure. And I think the build out of our digital infrastructures is going to be much more intense than we thought it was a year ago, because the U.S. is now moving to compete with China. So this is going to be as much about competing with China as anything else. We've never had government has never had industrial policy in the U.S. We're going to now. That is 100% on the table. The semiconductor industry, which is at the core of this big tech infrastructure build, and it's probably the simplest way to play it, has asked the federal government for a $32 billion subsidy to make sure they can stay ahead of the Chinese. That is, I mean, it was barely talked about in the press, but it's a big deal. And and I think what it's really telling you is that the game has changed. And I think we're going to see this investment happen in the U.S. and I think it'll be very good for the new economy businesses. But it's going to take a long time because the U.S. doesn't move on tech quickly. They move on tech really slowly. I think that's the issue. Is that we don't build infrastructure fast in the U.S. because state and local rules. Now they're sort of trying to change that. They're trying to federalize some of these things, but I doubt that they'll get.
Well, I mean, I can tell you that from my perspective, the big prize is AI. Right now, I mean, we have this in tech, this amazing confluence of, you have quantum computing beginning to come online. A quantum computer has more processing power than every computer that's ever been built combined. And so, then when you put on top of that sort of the advancements of AI that you're beginning to see, for me, it really, the next arms race, and it is with China 100%,
Yeah.
is really the big prize is AI and related to that quantum computing. And I absolutely agree. I mean, the United States, the old saw in tech was always that, the Chinese are good at, organizing and structuring, but, if you put a gun to somebody's head and say, be creative, they're not going to be very creative, right? If you put too much pressure on them. And that the US with this more laissez-faire, sort of
Different education
approach,
system.
right?
Yeah.
Different education system, et cetera. Really what we were able to, promote sort of organically was this incredible creativity. And I think, my view is I'm not very optimistic right now that, especially, given, the lack of leadership, on both sides of the aisle, in the last few years. I'm very, resigned to the fact that, there's a good chance that China sort of wins this, this battle.
I think about this one little thought, and this was I stole this from one of my colleagues who's a pretty bright guy, Danny, my Wharton grad. And what he said was that, look, China's sitting back there, they're watching us in total chaos right now, having marches and burning our cities down and doing all these different things that we're doing. And what are they doing? They're marching forward. They're pressing. They're basically like they now have
Hong Kong for starters.
Yeah, they just said like
right.
We're going to take Hong Kong. They're now like everybody know so basically they finally realized the whole world knows their game, and they're like, fine. And now we're going to go just take it, and we're going to win. And winners win because they want to win, and they want to win. They are an ambitious society that wants to. They're proud of their past, and they do. And what Americans do not understand about China is they do not want to repeat the Cultural Revolution. They're watching what we're doing here and they're going, that looks like the Cultural Revolution. That was a disaster for them, and they're laughing their ass off. And you know what they're thinking? We just got to send a pandemic over to them every 2 years, and they're done. Right? I mean, and literally, and look, someone's going to eat a bat again, and this is going to happen again. I mean, and it's just, and hopefully next time it won't be, the death rate we'll have figured some of this stuff out, but we're chaotic, and our political system isn't working. Our political system isn't doing things that benefit our country. You were talking about tech. I mean, it's very obvious what you need to do in tech. Anybody with an advanced degree in the world should be welcome into the United States. If you want to win, you got to have the people. And you can't. If you want to beat the Russians, invite them to come here and work. They'll come. Right? They'll come and invite the best Chinese. Make it easy for them to stay here. You come to university here, stay. Now they've tried to do these things, but the political system is so screwed up because neither side wants to give any ground because they just. It's just a disaster, and that is going to really hurt our tech industry a lot. And I think it's just, look, it's a numbers game in China. They just have more of everything. They don't have to be that creative. If you have basically five times as many PhDs as we do, you're going to win. And they're stealing everything, and they're going to steal everything. So whatever they don't have, I mean, I listened to a university. Number 2 guy at a university had dinner with me a couple months ago before COVID, and all he was telling me about was how freaked out his entire university was at their students on campus from China that are stealing everything from them, and how a neighboring university just had an entire lab taken from them. And he was just beside himself with how, and it's this thing where they need the money from the Chinese students. They want them to stay in the United States. And yet you're stealing stuff from it. It's insane. And so this is really complicated stuff, and our system isn't good at dealing with really complicated stuff. That's not how the American system works. Our system is designed to do very little. The Republican and the Democratic Party really don't do very much. I mean, that's mostly worked for the U.S. But unfortunately, I think we're at a pivot point where we're going to really have to step up our game, and in order to be successful. And I think it's just reality. And we all know what it's like to be not, if you are not the most advanced country in the world, technologically and otherwise, you are, I mean, who wants to be subservient to China? I mean, how lovely is that going to be? Can you imagine when China really can push us around, how scary the world will be? I mean, there are real consequences to losing.
China. China has I mean, Taiwan, as we're seeing with Hong Kong, it has expansionist, tendencies. Look, Patrick, I've been super appreciative. Very, very interesting, this conversation. What I'd really like to do, if you don't mind, is check in with you every few months. I mean, this is a story that's, playing out. We're coming out of the quarantine now. I mean, obviously in Florida, I think we've demonstrated how not to come out of the quarantine. But as we come into the fall, I really would like to check in with you, because what we're finding, as I said, is there are decades. The last 10 years, there was sort of a trend line that people sort of got too comfortable with, and now it really feels almost, if not week to week, month to month. There's just huge industry, huge changes going on, and these changes are affecting our pocketbooks and are affecting how we live and how we have to manage our money. So if you don't mind taking some time for us, I'd love to check in with you every few months.
This was a lot of fun. All right, buddy. Hey, have a great one.
Patrick, thanks so much. I really appreciate it.
All right.
Cheers. Bye-bye. Thank you.
Este fue otro programa de Aquí y Ahora, auspiciado por PAG.law, especialista en Venture Capital. Hasta pronto.